FSN Radio. It's all about what's next. Go to financialsurvivalnetwork.com and sign up for your free weekly newsletter. You'll also get 3 free reports. The Financial Survival Network. It's all about what's next.
Welcome. You are listening to the Financial Survival Network. I'm Kerry Lutz. It's 10/15/19. Well, hey, repo market, there's still things going on there. It's never been adequately explained exactly why that market tanked. We've got Gordon T. Long on with us now. Gordon is going to give us another perspective. Gordon, welcome back as always. So what is going on with the repo market? Has a bank failed, or have multiple banks failed? And now what's going on here?
Thank you for having me back, Kerry. It's been a while since we talked. You know, repo market, that's one of the most exciting things to talk about, right?
Yeah.
How boring
like
it can be. But right now, it is the most important thing for everybody to be truly trying to understand what's causing this historic level of volatility.
Yeah, historic. Is it all right?
Oh, and it's you know, this are, when you see this sort of thing happen, it's always an issue of trust, and in this case, the banks, and it's trust between each bank in terms of counterparty risk. I don't know how many times we've seen this, and I was tracking the repo market back in the late '90s, and it was if we got $1 billion, $1.5 billion overnight, and nobody paid attention to it at the time, but you know, we followed M2, M3. Well, they had a thing called M3, if you recall at the time.
I remember M3. They got rid of that. Yeah.
And it wasn't the labor numbers everybody paid attention to. It was the growth of money supply. We were always focused on. And this repo market was a way of pumping money in without monetizing, if you would, money. So it was a kind of a sneaky way that the banks had of doing it, and handling the collateral that went with it. Well, now we're running anywhere from 70 to 90 billion a day.
Yeah.
But it's not just because of this reaction we've seen here in the last few weeks to bring it up to these kind of levels. It's just a steady and unmitigated growth in this repo market. But you know, there's as many opinions on what's behind it all. But my personal opinion, to net it out, is I believe there's a serious bank problem with at least one, possibly two players. And the fact that the individual players themselves are so quiet begs a lot of question. It's my personal opinion. It's either Deutsche Bank, and it's because of their $50 trillion of derivative books. I mean, we all know that Deutsche Bank has been in problems here for at least 2 years. Oh, yeah. The German government tried to merge them with the Commerce Bank and failed to do it. I mean, these are the two biggest banks in Germany, and that deal didn't happen. They just sold off their trading assets to BNP Paribas, and that in itself caused some liquidity issues. But they've got this derivative books, and they've been on the wrong side of a lot of trades for a long time. So I'm not trying to say that Deutsche Bank's about to go bankrupt or blow up, but that may be a possibility. But what I am feel, there's a lack of trust with them, and they're the biggest holder in terms of, if you look at the reserves of foreign bank reserves in the United States, and foreign banks are part of the problem. Is Deutsche Bank's by far the biggest.
Yeah.
So that begs a question too. Though, you know, I don't want people to think I think there's a excess reserve problem at all, though I think we're getting down to the zero bound. But the other bank I suspect people need to pay attention to is JP Morgan, and specifically this whole synthetic ETF business that they're into. I think there's a lot of worry there because, you know, ETFs have a problem when there's a liquidity crisis almost immediately.
Yeah.
But we're watching both of those very, very closely. But the bigger point is irrelevant of what's going on in there. It's the Fed is pumping money in. They don't have to call it QE4.
Is it QE4?
And we're north of 300 billion,
going
to 400 billion already. Sorry, Kerry, I didn't mean to go on there.
That's all right. It's okay. Is it QE4?
Yes, it is.
All right. And how do you define it?
I mean, Powell wants you to think not. And his argument is, hey, it's not long-term money; it's all short-term money. Look, liquidity is liquidity. When you're buying, okay, so fine, I got 30-day, 90-day money or short-term money. Can still turn around and buy 10-year bonds with it, right?
Yeah.
So it still flows. It's fungible.
It's really
That's the point.
QE4.
And I think we've all forgot what that word means. So he's trying to buy himself some time. I mean, and he doesn't want to. What's he supposed to say? We've got a real scare within the banks that they're on there, that their collateral is not.
So this is QE4,
valuable.
And the banks don't trust each other anymore, right?
Well, no, because it basically goes back to the magnitude of rehypothecation that's been going on for years, and that is nobody trusts the collateral that's underlying the loans, and on the books, and there's just big issues, and Kerry, we get so trapped. If you remember, when we came out of the 2008 financial crisis, one of the major reasons we turned it around so quickly, and it wasn't just all of facilities, the 12, 13 facilities we subsequently came out. You remember this concept called mark to market?
Mm-hmm.
Yeah, well, that was banks had to mark all their assets to market. Well, we said no. We removed that regulation rule from them, and we said, well, now they could mark to magic. Yeah. But that was going to be a temporary stopgap, just so that the banks didn't collapse, and because the argument was, hey, these prices are ridiculous in this state of crisis. Why should the banks have to adjust that magnitude when this is a temporary phenomena? That was 10 years ago, and we have never re-implemented mark-to-market, Kerry. So how would you feel another bank trusting the other real assets of other banks, especially when there's so many banks? And I'm not talking about the major U.S. banks. I'm talking about the banks, all the number of banks we have around the world, right?
Yeah.
And they're all interlinked because they're all handling the Eurodollar business, if I can say that. So that's the scare. And it's the first one out the door is the safest before everybody else rushes out of the theater.
Yeah,
and Powell just doesn't want to cry. Yeah. He doesn't want to yell fire right now in the theater.
It's like that movie Margin Call. You saw that movie?
Exactly.
It's like, I guess in the movie that was supposed to be Goldman Sachs. And they realized that the emperor had no clothes first. So they sold off all their mortgage-backed securities in a day and stuck everybody with them. They still lost billions, but they didn't really care because they were the last, they were left standing, right? So it didn't matter.
Kerry, I as big as this is right now, I think it's just, it was inevitable. And I can remember, in the early 2000s after the dot-com bubble, putting out papers about that we were on a road to a fiat currency failure.
Yeah. And
we didn't know when, but at some point, the debate, and I was actually, because I saw what they were doing in the repo market, troubled me at the time, but that eventually we'd see fiat currency failure. And then it was a tough thing to really, invest in because it's a long-term kind of process. I think we're now, we have a 4-stage roadmap, and I think we just finished stage 3 and going into stage 4, which will really start to give the undermining of a fiat currency failure. It's not imminent, but it is. It's now going to take the shape and the form where all the issues associated with unsound money that has pushed us through, where we have capitalism now is impaired. We have really a creditism system that these issues are showing the weakness in fiat currencies, whether it's de-dollarization and the rate that it's happening right now, effectively currency wars. So that's beginning, and that's translating for the gold players out there, that I think we're finally starting to turn this long drought where over the at least the intermediate term, we're going to start to see upward pressures on hard assets right across the board, precious metals specifically. And I think I was saying there before we started, I was a big gold bug from 74 through about 2004. I really was. I still have a lot of the gold holdings from there, buying companies that Placer Dome bought out, and Placer Dome was bought out by Barrick Gold, and went through all that, but I've just let them sit. But I moved off into other areas. But I am now sitting back and saying, hey, this is where you got to start looking today. Yeah, and I think if you've been in, you've done all right. But it was a good ride from $600 up to $1,800 and then back to $1,300. But the big money, I always felt that when I was in it was when we went from $35 up to 350, percentage wise, right?
Right.
But after that, the percentages haven't been as good. But I think we're moving because of the basement rate at which this is going to unfold on this stage 4, which is really going to be, I call it collateral guarantees, but the amount of new printing money, if you would, modern monetary policy, MMT, if you would, these kinds of things, the helicopter money that's still in front of us is going to be significant.
No doubt.
We've talked about it. You and I've talked about it many times. But now they're truly trapped. They're and throwing more money at it is taking more and more money. And they just don't see any other solution. That's the real problem right now.
Well, what other solution is there?
A reset. You have to reset the global system such that money actually becomes a store of value.
But and
the reason, and that in itself is, you need agreements across. Good luck with that one, right? It's going to take a crisis to get anybody to agree. You look at the trade discussions we have between Trump and China. We can't get any agreement on anything there. That's relevant to what he said last week. So just imagine trying to get agreement around the world on a basis for stable money. I don't think so.
No.
And things are shifting too, Kerry, right now because I think I argued with you on previous shows. I argued with you that after 2008, 2008 financial crisis was about a financial crisis, and it was primarily about the U.S., though it spilled around the world, but it was a country-specific, and it was financial. And our roadmap said, hey, this is going to continue to grow, and the next issues are going to merge into being economic, not financial, but are going to be economic, and they're going to be regional in scope, because we didn't solve any of the financial crisis issues. We papered them over, kicked the can down the road, and they were going to spill over into economic issues because of unsound money policies. Well, that happened, and we saw in 2012, we saw the European crisis. Remember words like the pigs and all the peripheral problems. We just papered those over, and we have other regional issues. And then we said, if this keeps on going, what it's going to do is it's going to lead to a third area, which is going to be political. It's not going to be just financial and economic unsolved, but it's going to be political, and it's not going to be country or region. It's going to be global. And so with a political issue, what we're going to see is we're going to see conflict. We're going to see polarizations, left and right, the left wing, the right wing, as if we're not seeing that right now. We're going to see inequality, which is being built, the rich and the poor, the disenfranchised, because of all these growing unsolved problems. And when we get to that stage, it's going to be about conflict. And I think that's what's going to drive. I don't mean to be long-winded here, Kerry, but I think that's what is going to lead to some of the forced on the fiat currency failures that we see happening. Because the underpinning here, the basic problem is we don't have sufficient real rate of economic growth. We have an illusion of growth. We don't have the pie is not growing in real terms fast enough. And it's that first and second derivative problem that we're really facing right now. And we've written all sorts of papers here over at MAD-SII on that particular subject. Hey, are you with me? Do you agree with me, or do you think I'm off track there?
Yeah, well, I don't. Yeah, I'm not. I don't think that the Chinese model is the answer either.
Oh God, no!
Both models are going to die inglorious.
They're the biggest credit problem in the world right now.
Yeah, exactly.
It's not the United States. I mean, our issues are different. They're the biggest by order of magnitude. Credit growth is China.
For sure. Hey, by the way, guys, any questions or comments for Gordon? Please feel free to give us an email. Send one to us. We'll share it with Gordon. Email address is kl@kerrylutz.com. So, Gordon, looking ahead here. So, can the Fed once again wave its magic wand and restore faith in this repo market? We saw it happen in 08 and 09. Basically, the banks didn't trust each other's collateral, and they kind of withdrew from the market. Those that had the money wouldn't loan it, and those who needed the money couldn't borrow it. Are we going to see something like this again?
FSN Radio. It's all about what's next.
Silver One Resources is an exploration and development company backed by strategic investors Eric Sprott and SSR Mining. The company is focused on its Candelaria mine project in Nevada, where there is already a historic resource estimated at 127 million ounces of silver. The Candelaria mine historically was the highest grade silver producer in Nevada, generating over 68 million ounces of silver at an amazing average production rate of over 1,250 grams per ton. The project has tremendous expansion potential as past drilling has outlined deeper, high-grade silver targets for future drill programs. Silver One is highly leveraged to the price of silver and is cashed up and poised to increase shareholder value. Silver One trades in New York under the ticker SLVRF and in Toronto under the ticker SVE. To learn more, go to silverone.com. That's silverone.com.
The Financial Survival Network. It's all about what's next.
Yes, we are. And can the Fed restore confidence? It's a real big question. Mm-hmm. But how to answer that is, remember, when the government or the powers to be get in trouble, they cheat. And that's what we underestimate. And when I say cheat, they change the rules, they change the laws, and they change the regulations. And I got a list of those examples. I just mentioned mark to market. They will change the rules. And the biggest issue right now is collateral. Mm-hmm. And the problem is it's trusting each other is how secure is the collateral. And so what the central banks have got to do is, in some form, shape, or fashion, is to guarantee collateral.
Right.
That's what if they can guarantee the collateral, then they can keep pyramiding the debt and the growth of credit. And they have to keep doing. They have to do that, because we've moved. Kerry, we were about, when we came out of 1980, when Volcker broke the interest rate, and all of a sudden, ever since then, interest rates have went down. We've went down in stages, and for the first from I would say 1980 to 2000, it was about the availability of credit. And so we didn't. There was no credit cards back then, or they were hardly even used. Nobody had a FICO score, if you can even remember that era. I grew up in it, but it was just availability of credit, and it was that credit that really grew us. And remember what happened in 1980. It wasn't that Volcker just broke the back of inflation. Mm-hmm. It was because what happened was we came off in 1972 of August, the gold back of the U.S. dollar. That was not the big deal. It was, but it wasn't. The big deal was in 1980, when all of a sudden balance of payments globally didn't have to be settled in gold. They could be settled in credit. And the moment that happened, our balance of payment went changed. Our balance of trade went negative in a big way. We became a consumption-based economy in an accelerated rate. That's when Japan came in. But it was about availability of credit. When we busted in 2000 with the dot-com bubble, after then we'd move where up until then we were about a capitalist system where it was about savings and investing in productive assets. It was becoming more and more about credit and about consumption. So after 2000, the only way Greenspan could change that was about making credit cheap. It wasn't just the growth of credit. He had to make it cheap. And with reflation, and he lowered the interest rates. And so we had credit growth of over 2%, and that's what sustained it. But in 2008, that changed because we couldn't get credit growth higher than 2000. And so we went to this next stage of zero bound and NERP, and that was really where we QE, QQE, et cetera, we took it down to zero. So now, where do you go from there? The only way out of this in printing it is you got to start guaranteeing the collateral. And so collateral guarantees
nationalization effect.
They won't tell you that, Kerry.
But it's nationalization.
You're not going to policy. That's going to be the new hidden area underneath the policies. The pension plans globally dictate that. Absolutely dictate that.
Well, we're really looking at nationalization, aren't we?
Yes. Well, they're going to have. It is a nationalization of pensions that are, even if they're not already by the government, but the form that'll hide the collateral guarantees will be if you would, nationalization of different areas. It'll be packaged that way. So the good news is this is going to buy us more time. I think it'll buy us another 8 or 10 years before the whole fiat currency really implodes. Mm-hmm. But during this period of time, none of us are going to be naive to, basically Bernanke's enrich thy neighbor, where 95% of the world's currencies are trading are only 4 currencies. And if they're all debased, what's it relative to? Well, it's relative to gold and silver, but it's been such a manipulated market. We all know that story. But out of there, it's going to finally have to be broken loose. People the banks themselves are so nervous that they're buying gold, for God's sakes. You never heard of that before.
Yeah, well, they're not admitting that they're doing it, but they're obviously doing it. So what's the system going to look like afterwards, Gordon? Obviously, you need to have gold and silver to protect what you have
and
now.
all forms of hard assets, Kerry.
Sure.
That it's more than just gold and silver. I think a really balanced, broad-based portfolio. You basically have to figure out how to get out of fiat currencies, and you have to figure out how to get out of the banking business.
Yeah.
So as volatile as cryptocurrencies are, and I've been an absolute proponent of them as a concept and of removing yourself from dependencies of banking and a debasement of currencies. Yeah. They need to be stable, and they need to have some real assurances in them. And I think they're finally starting to mature. So I can see explosions in cryptocurrencies in the future too.
Really?
As a way of fleeing out of countries.
Yeah, but these cryptos are so corrupt here.
Yes,
and
precisely.
They're being manipulated. I mean, I love the concept of them, but they're really corrupt.
Yep, and I've stayed away from them because of exactly that. But I'm really trying to peel it. We're trying to peel it now to figure out how to protect ourselves in it. And how? And there's new securities that are coming out that are creating baskets of them.
Yeah,
so you're not betting on one versus the other. And I know I'm not proposing those, but we're looking at all forms of that because we think there will be real opportunities there. Right now, it's been something to stay away from.
Well, there is no fundamentals of cryptocurrency.
No,
it's all trading as a very it's not a real market. It's strictly based upon supply and demand with no underlying fundamentals. Now, people will tell you, well, that's what a market is, but this is not a market. It's not real. It's very predictable when these crashes are going to come. We've seen them happening on and off, over and over, right? I mean, is that a market you can have any confidence in, more so than a fiat dollar?
It's anybody's guess right now, right?
Yeah, it just seems to me I wouldn't be adverse to putting 5% of my total portfolio into it, which it's not now, but I wouldn't be adverse to it. But
I wouldn't see it being any higher than that, even when you find some good solutions.
Yeah, I mean,
because you need a broad based.
Yeah, we should.
But I would argue it's not something to be quickly thrown away and discarded any longer. It needs to be carefully over the next year to year and a half thought carefully through.
Well, right now it's trading
as much as others. We can get off into diamonds, and I'm talking about colored diamonds, not the retail diamonds. But there's lots and lots of very good hard assets to protect yourself with, and I think we've discussed those in the past.
Yeah, of course. And we should mention right now, Bitcoin's right around $8,100. It was up to $12,000, $13,000. So it's still in a bear market, cryptos. My feeling is it's still probably going to go lower. Maybe it's hit. We'll have to see if it goes below 3,200. But my gut feel is it could well go lower. Go back to my original $2,000 price target, which was a 90% loss from its peak of 19,000, 1,500, 1,700. It could well do that because not enough people know about it. There's just a lot of reasons. We don't need to get into them here. Anyway, Gordon, we want to find out more about you. Where is the best place to find your extensive work these days?
Best is matasii.com, where we integrate the whole macro element into tradable strategies using technical analysis, or macro analytics on YouTube, where we post a lot of videos trying to explain some of these concepts.
All right. Well, hey, excellent. So anyways, questions, comments for Gordon, just email me, kl@kerrylutz.com, Twitter feed @KerryLutz, Facebook page, Financial Survival Network. Whether you're on YouTube or you're listening on a podcast platform, you will be able to subscribe, like, and share this program as well as all the others we do. Please do it. Really helps a lot when you do it. We're up to 7,000 subscribers on YouTube. Been a long, hard battle. I really hadn't even focused much on it. Only started doing that recently, but we love to hear from you. We love talking to you out there, all you FSN community members. So please don't hesitate to just write us and tune in. Gordon, always a pleasure. We'll talk to you again real soon.
Thank you for having me, Gary.
FSN Radio. It's all about what's next. Go to financialsurvivalnetwork.com and sign up for your free weekly newsletter. You'll also get 3 free reports. The Financial Survival Network. It's all about what's next.